We can see here where, we were kind of coming closer to the 3% threshold, as we have a 50-50 policy between equities and fixed income. We rebalanced on December 17th, which we'll review later, but it's quite a bit of growth and change for a little under 2 weeks at the end of the year. But overall, this is a large amount of growth from when we took in the funds. I believe we took in the funds into State Street at about 81, 82 million. So we've seen quite a bit of growth in the last 2.5, 3 quarters.
Okay, any questions of Steve? If not, let's go to investment performance, Rob.
Great, thank you, Bob. For FFE, the portfolio value when the quarter 12/31/2020 went up from 89.6 million to 95.8 million, an increase of 6.2 million, or up 6.92%. The 6.292% was the weighted average net of fee return during the quarter. Since inception, May 1st, the net return has been 18.25%. So impeccable market timing by FFE. Equities, as Steve mentioned, a little bit over 52%. During the quarter, the equity portion, which is the S&P 500, was up 12.13%. Fixed income at 48% was up 0.87 during the quarter. The inflation adjusted real return for the quarter was 6.85, and the real return since May 1st is 16.66%. You want to go 2 more, Steve? Thanks. 1 more. So here on the left-hand side simply shows it is a 50-50 portfolio. As Steve mentioned, equity did so well. It was in balance, so up to 52%. Fixed income down 2.1%. That is being addressed. We've talked about Jennison. It's the same portfolio throughout the funds that we've talked about this morning. The portfolio, the characteristics that stick out to me is Jennison is taking less interest rate sensitivity risk, slightly less duration in the market at 5.99 years, whereas Bloomberg Barclays Index is at 6.1. And the other part is that during the fourth quarter, which was the same during the third quarter, but more pronounced, Jennison moved away from the safe haven U.S. treasuries and agencies to some extent and was more into corporate and to asset-backed securities. The sector allocation of the Genesis fund, the sector allocation by itself added 57 basis points to its performance. Its net outperformance was 22 basis points over the Bloomberg Barclays US Aggregate Index. Next page, Steve. This is by month. We'll get a little more history here and start making it by quarter like the rest of it. But last month, the month of December up 2.14%. November was a great month, which was up over 6%.
Hi, this is Dan Dement. I think you just called me.
Hey, Dan, can you mute yourself? Or Steve, could you mute Dan?
And
Okay, we're good to move forward.
Yeah, okay, thanks.
Next page, Steve. Again, not a lot of history here, just starting in May, but cumulative returns since inception, 18.25%. We remember the market bottomed officially March 23rd, and this portfolio's inception was in early May. The next page simply again shows the same depiction of the imbalance away from target caused by the outperformance in equities. On the next page, Steve, simply shows BlackRock, the performance from May 1st to June 30th, then a full third quarter, fourth quarter, and return since inception. The S&P 500 up 33.68%. And during the same time frame since inception, the Jennison bond portfolio, roughly 50% of the portfolio, was up 2.8%. Next page, Steve. Now, the thing to mention here, and Katie, you might have to jump in to help me recall this. The BlackRock equity index B follows the S&P 500 within a basis point or two. There was a timing issue created when the money, I think, sat in cash during a down day and then was actually put into the fund the next day. So it appears there was outperformance, there was tracking error from the S&P 500. In reality, there wasn't. So Katie Richards or Chris, if you recall exactly what that is, please jump in and save me. If not, pretty sure that's what it was. It was a one-day timing issue.
It was, there's a footnote on this page 15 of 45. And BlackRock wasn't fully invested and implemented until May 6th.
Yeah,
Yeah.
the order was
they-
put in. It took 2 days to do it. And in those 2 days, the market moved. It's that sensitive.
We missed a downturn.
Right.
Yeah.
Okay, great. Thank you both.
Yeah.
So that's it. The next page, Steve, 7 of 7 shows the outperformance in the fourth quarter over the benchmark, 0.58%, and since inception, 1.05%. So this portfolio is off to an amazing start, but part of it is timing, but also in a relative sense versus its benchmark, it's done well. That is it for FFE performance. Are there any questions?
No questions that I hear. Let's move on to Steve, the expenses, if we could.
Absolutely. We have our mostly standard operating expenses. The one out of the ordinary would be the attorney fees for the insurance review, $1,275 there. Total expenses, $78,654. I do want to highlight that again, State Street is still a bit behind on their billings here. I think we're only through April again here, so we've continued to try to work with them on that issue.
Steve, this is Chris. Is there anything I can do to help move State Street along?
From our understanding, it seems to be more of a back office issue. We've been pushing on it for quite some time, and I don't know if it's just our rep or if it's just purely back office, but we haven't been able to seem to get movement. So if there's anywhere else you can push, that would be helpful, I suppose.
Hey,
Yeah,
Steve, as a former CFO, I would just say this is a cash flow opportunity. So, I mean, I understand the desire, but as long as the money is in your pocket, it's probably better. So,
Dean,
ask them to do their job, but
I had exactly the same reaction. No need to push if it's a question of them billing you.
Bless their heart.
So I guess at this point, can I see is there any other discussion or movement for approval of the expenses?
Can I have a motion to approve the expenses?
I'll move approval.
Support.
Motion and support. Any discussion? Steve, let's do the roll call, please.
Okay, Nick Griffith,
Yes.
Joshua Sledge,
Yes.
Sandy Doctor,
Yes.
Dan DeMint. Oh, Danny may be muted.
Yeah, Dan might be muted. Let's just move on without Dan
Okay.
at this point, Steve.
Okay, Dean Berge,
Yes.
Randy Eberts,
Yes.
and Bob Salisbury.
Yes. So the motion is approved, even though we don't have Dan. He might have had a problem that he had to deal with on the phone.
There we go.
Steve, let's deal with the other items quickly if we can and just move things along.
Okay, sure. Just kind of highlighting here, we have our rebalancing that happened December 17th. You can see at the time rebalance, we really got pretty much dollar for dollar into a 50-50 split here. But as we saw, there was a deviation just in those last couple of weeks of December. But overall, we're still tracking within that 3% of policy variance that we allow. I guess that would, did I miss anything? I think I got everything. Oh, cash flows, I'm sorry, overstepped cash flows here. So format looking a little different, just being that this fund is still relatively new. Outside of just management expenses and operating expenses, we don't have anything at this time. at the moment, there's a potential that this time next year we may need to draw on the endowment. However, I know that there are other discussions happening. I don't know, Steve Brown, it's up to you if you'd like to share any of that at this time, or just we'll kind of continue to keep the committee updated as we move through this year.
Thanks, Steve. Regarding expenses, you mean?
Being future endowment draws.
Yeah.
Because at the moment, where the agreements that we've had in place would run out at the end of this year, and then next year we need to potentially do an endowment draw.
The agreement we have in place is through the end of fiscal year 2022.
Oh, okay. Thank you for correcting that. So we have another full year before we need to even consider doing any endowment draws outside of operating expenses.
So, Steve, all the, let's say, aspirational projects I hear about around town comes out of the other fund, right? So far till the end of this year.
Correct. Those are donations made directly to the city.
And then, okay, and then those monies for projects then come out of that fund and not our fund here that we're looking at.
Correct. That's what in 2+ years is what we'd be potentially looking towards here. And aspirational is it's the bucket of fund that's not required, but if there's funds available, obviously the city likes to move those projects forward.
Yeah, and those are the ones that I think the foundation likes to to think about funding, right?
Yes.
Yeah. Okay.
So Steve, just so I understand, I mean, the agreement you're saying runs through 2022, but presumably if that was not re-upped or whatever, then the draw from this fund would really be to cover the needs relative to property tax reductions. Is that correct? Or
yes. So it's property tax and budget stabilization. Those two buckets together are right around 17 million. And those are the requirements that we would need per the FFE bylaws if that agreement's not extended. And not saying that it needs to be or not. We'll see how fundraising shakes out here over the next 2 years.
Okay, great. Thank you for the clarification.
Yeah, and I think it simply means that as a committee, as we get closer to the end of fiscal 22, that we'll have to keep an eye on asset allocation so that if it does appear that significant draws will be coming out of this fund, that we might have to change the allocation.
Yep. Okay. So I guess that covers those two items. I guess those are my two items right now. Do we need to cover the derivatives report at this time?
Yeah, so I'm going to ask Rob, is there anything important that we need to know about derivatives reports, or did it follow essentially the pattern that we've seen in the previous portfolios?
Yes, it did.
Okay,
so there's nothing further to comment on.
Okay, and I'm going to say the same about articles of interest and due diligence, activity reports, corporate governance. That is all routine items that we've dealt with. Gains from securities lending we've talked about. And then let's talk about the E&O insurance, Steve. We talked about that for a moment, but it was interesting to see that sort of there was quite a different conclusion with this policy than there was with the previous policy.
Yeah, so the two things I'd like to really point out is this policy is only quoted for $1 million of liability coverage. That is largely due to a mix of factors. Largely the FFE being still a relatively new organization, and the funding, the current funding level, and the aspirations for a $500 million endowment. Underwriters, I guess the analogy that I've been given is underwriters don't want to insure the house before it's built. So they're, insurance companies are being extremely careful with this. I know when we went up to market, we looked at over a dozen different insurance companies. Only one came back with a quote. As we reviewed that policy, you can kind of see in the conclusion section here that there is some concern about the rendering of professional services. I guess the clarification I have also received from our insurance broker was he does not consider the services by this board to be professional services, as you are a volunteer board and not being paid for your time or your services to this. So he doesn't see this as being as big of an issue as the legal review. He has reached out to the company's underwriters for clarification and their understanding of that clause in relation to how this board operates. Unfortunately, we have not been able to get a response from their underwriters yet. And so that's kind of, in a nutshell, all the parts that are moving in regards to obtaining this insurance. So we're still waiting on the underwriters. Our insurance broker is kind of going back out to market to continue to look that as the FFV's been around now a little longer. We've had our investment fund, for a period of 8 months now. If there's more comfort in those other companies. And so it's just at this moment still kind of waiting to hear back from any of them. But that's kind of my summary of the situation.
Okay, well, Steve, if you could keep us updated on that, in particular, the response that you get from the underwriters as to the definition of the professional services and the kind of coverage. I think we do want to make sure that committee members are protected. And so I appreciate your continuing to work on this.
Okay.
I'm going to skip down to public comment. Steve asked to see if there's any public comment.
Yes. Is there any public comment at this time?
No, there are no public comments at this time.
Okay. Future meetings are listed on the agenda. I'm going to do a truncated around the table. Instead of calling everybody, I'll ask anybody to raise their hand if they have any items that they'd like to bring to the committee for attention. Looks like Randy, you've got something you want to bring up.
I just had a question. Maybe it'll help the new members too. But we saw placeholders for some of the other managers that we could place, in there, like, growth, value, whatever you want to call it. This agreement up until the end of 2022, where does that place us in terms of putting money with other managers? Can anybody help me with that?
In what sense, Randy?
Well, I mean, right now we just have it in BlackRock and Jennison. Can we go further than that before the end of 2022?
Well, you are able to, but I think the understanding is that until we reach about 350 million, it just doesn't make a lot of sense to go out and get different managers.
Okay.
And the managers that have placeholders, they may or may not be the managers that occur at that point in time.
Sure. Okay. I'm just on other committees, investment committees that have much less money than this, and we have a whole variety of managers. So I didn't know where we stood on this. Thank you.
Yeah, I think, Randy, it really comes down to the fact that until we have a real endowment, I don't think we can afford to take significant risks that with the expectation that we have a 30-year time horizon. So now we've just got an uncertain time horizon, and we stay relatively conservative.
Yeah. Well, that's right. Yeah, and I'm not sure quite where we're going to stand at the end of 2022, but we'll see. It's just a matter of waiting until then, I guess.
Yeah, I'd say it's very possible that say before we get, 6 months before the end of 2022, if it looks like there's no action, we might even move to a lower equity allocation because of the likelihood that there might be cash withdrawals from the portfolio.
Yeah, you start moving money out. Yeah, get conservative.
Any other? Sorry, Steve. Looks like you have a comment you want to make.
Thank you, Robert. The one thing I would add to that timeline is that the nature of city's budgeting beginning in August or September of the preceding year would mean that we would all need and have more outlook than is implied by simply noting that the agreement ends at the end of the 22 fiscal year, because just the nature of planning for the enormous budget that the city is involved with begins really at the beginning of that year and is drafted throughout that fall. So I would expect, better line of sight on this information well in advance of December, for what that's worth. And I would also just like to say, it's with apologies that President Graham Williams was not able to attend today. She has attended obviously in the past and intends to come again in the future, but had a conflict today. So appreciates the work and with apologies was not able to make it.
Okay, thank you.
So can I just add, Steve, you're saying that the budget that's put in place for the city would really describe what the first two buckets would require, and then that would leave, you know, something for the aspirational project bucket, I guess, right?
Well, it's all of a piece. The budget stabilization dollars and the tax
Right.
relief dollars are what we call the shalls. Those are
Yeah.
required. The May is the aspirational, which those are the higher profile social service and community support projects that we have supported, in the kind of $8 to $10 million per year area for the last several years. But they all are passed in the same budget by city commission at the same time. So come what may, if we're just kind of laying out various scenarios that may or may not happen, they would all still be in the budget at the same time, no matter what. So
So the
that,
aspirational bucket would have a budget to it as well. Is that what you're saying?
indeed.
Yeah. Okay. Thank you.
Any comments from anyone else? And Steve mentioned it. I don't have a screen that captures everybody at once. So if I'm missing someone.
Now, I have a quick question of Steve Brown, if I may. If over a period of time, there has not been an aspirational draw, does that put in jeopardy the fact that it is an endowment? Would that jeopardize it in any way?
You mean a minimum required distribution draw?
Well, yeah, for aspirational projects, or do the budget and the tax stabilizations keep it qualified as an endowment that is tax exempt?
It's our understanding that the endowment has a target and really exists when at least a certain portion of that target is met. Meanwhile, there's cash flow that is covering the liabilities, if you will, of the foundation itself to the city. So it's been our understanding that cash flow satisfies the requirement of what's in the bylaws. Now,
Okay.
statutorily, as a 501c3 type 3 organization, it's different than a private foundation.
Yeah.
With that 5% kind of
Okay.
test.
Thanks, Steve. I appreciate it.
Anyone else? Looks like we have none. I'm going to adjourn the meeting and thank you all for your participation and input. It's been a pleasure seeing you on Zoom, and probably see you on Zoom in May, and who knows where we'll be in August. So thank you all and goodbye.
Okay.
Yeah.
Bye all. Thank you very much. Goodbye.